Trading psychology is the foundation of long-term success in financial markets. While technical analysis and strategies are essential, a trader's mindset ultimately determines their ability to profit consistently. Emotional control, discipline, and the ability to manage risk effectively separate successful traders from those who struggle. Fear and greed are the two dominant emotions that often lead to irrational decisions. Fear causes traders to exit trades too early, hesitate on entries, or avoid taking necessary risks, while greed pushes them to overtrade, hold losing positions too long, or ignore their risk management rules. Recognizing these emotions and learning how to control them is crucial. Discipline is another critical aspect of trading psychology. Many traders create a well-researched plan but fail to follow it due to impulsive decisions. Sticking to a strategy, even during losing streaks, requires mental toughness. Losses are inevitable in trading, but how traders react to them determines their success. Accepting losses as part of the process and maintaining emotional stability prevents destructive behavior like revenge trading, where traders try to recover losses by making irrational, high-risk trades. A strong mindset allows traders to detach from outcomes and focus on executing their strategy with consistency. Patience plays a major role in trading psychology. The market does not always present opportunities, and forcing trades often leads to unnecessary losses. Waiting for the right setups rather than chasing the market is a sign of a mature trader. Similarly, traders must learn to trust their analysis and avoid second-guessing decisions based on short-term price movements. Developing confidence in one's trading plan reduces stress and enhances execution. Risk management is closely tied to trading psychology because it helps prevent emotional decision-making. Traders who risk too much per trade often struggle with anxiety and make impulsive adjustments to their strategy. Keeping risk per trade at a manageable level ensures that losses do not have a psychological impact that disrupts decision-making. Using stop losses, position sizing, and maintaining a proper risk-reward ratio are key factors that keep emotions in check. Lastly, self-awareness and continuous learning are essential in mastering trading psychology. Keeping a trading journal helps traders analyze their emotional responses, identify patterns of mistakes, and refine their approach. Understanding personal biases, weaknesses, and strengths allows for long-term improvement. Trading is as much a psychological battle as it is a technical skill. The best traders develop resilience, stay disciplined under pressure, and adapt to market conditions without letting emotions dictate their actions. By mastering trading psychology, traders can build the mental edge needed for sustained success.